So thank you everyone for coming today. Welcome to today's class on price action trading on any time frame. But that's actually going to be the segue into how we start today's class. As you all know, I always start the class with a lesson, and that lesson could be about trading psychology or some of the challenges that you're going to run into trading or things that you can do to, help with discipline or money manager, various aspects of the trading experience outside of the actual systems. And then once I cover that, then we're going to spend the bulk of the class talking about systems. But I still want to pass these lessons on to you because if trading was all about systems, you'd all be wealthy right now. You all have plenty of systems. You all have been exposed to systems from myself and other good instructors here. You should be all, trading profitably day in, day out. And why are you, if you're not doing that, the question is why? It's because of trading psychology and the mental, emotional, and spiritual aspects of this. And so I'm going to start off with the experience I had with the accident, and I'm going to talk about a trader of mine that's having some challenges and how I made some suggestions for him to deal with that. And then we're going to talk about several different setups on price action time frames, anywhere from the 3-minute up to the 4-hour. So right before the moment I was going to hit this guy, I definitely prepared myself for the impact as much as possible. And, of course, I tried to be as flexible and as loose as possible because when your muscles are stiff, you tend to have worse injuries at that point. So you have to learn to relax into the motion. The bottom line is your muscles are not going to be strong enough to stop an impact, of you hitting a truck. And so, but the moment after I hit the truck, I had noticed the damage to my body, but I realized I was okay. But I had noticed that there was something a little bit off energetically, and that was partially just the shock, the experience of hitting something. It's the first time on a motorcycle I've ever hit something. And so there's a certain psychological shock, and, there's kind of the dealing with that of, I wasn't really worried about my life per se. I recognized that I was probably going to survive this, pretty quickly I realized it. But still there's a shock. There's a psychological shock, and that shock creates an imprint on your experience, just like this one did. And I had noticed that as I was, as I decided to turn back and go back home, luckily my bike was in good enough shape that I could ride back home, that, it wasn't just me riding more cautiously. I was actually riding with a little bit of fear, and I noticed that. I noticed in the way I was making turns. I noticed in the way I was positioning things. It wasn't just I was making adjustments because I was trying to be more cautious. I'd actually noticed that fear had actually entered into my driving and the way I was riding the motorcycle. And that had actually an impact on how I actually handled it from there on the way back home. I think it's understandable that somebody would be, riding a little more cautiously from there out, but to be riding with fear, the constant fear that something else might happen every single second, that's something extra. That's an added component to the experience. And I had quickly realized that emotional and psychological shock had imprinted itself on my psyche. And if I had let it remain there, that the next few times that I take my motorcycle out, I might not just be riding more cautiously, I might be riding with that fear. And it's one thing to ride with caution, it's another thing to ride with fear. They're two different things. And, from my training in yoga and meditation and from my experiences in trading, recognizing that how fear has an impact on my life and how that imprint would have an impact on my life, I said to myself, I got to clear this from my psyche. I got to clear this from my mind. Otherwise, it's just going to be there. And that fear will infect my driving, and it may even cause me to get into another accident. And so I actually, there's certain things that you can do, techniques you can do in yoga, certain pressure points you can work with, certain clearing techniques that you can work with these points, and then you can clear the experience. And so I did that. I have somebody who I work with back home who I've been working with for 12 years. They gave me the subtle pressure points that I needed to adjust and the techniques that I needed to do, and that was it. I was able to clear it. And as soon as I cleared that from, just from my psyche, so to say, the next time I got on the motorcycle, that fear was gone. Yeah, I was still driving cautiously, but I wasn't driving with fear to where it was actually impacting the way I rode. That is something that happens not just from a physical accident. That can happen in life, and that can happen in trading. It can be an experience with a person. It can be an experience that somebody who means something to you and they say something that's very traumatic to you or shocking or hurtful, or it can be an experience in trading. You can have certain experiences in trading that can imprint on your psyche. And if you don't recognize that, they will create either fear or an emotion or a response or a sort of imprint on your psyche so that when you're making new trades in the future, you hesitate, you start thinking about that big loss that you have, maybe you're a little fearful, you analyze too much. All these things then inhibit your trading in the moment. Instead of being present in the moment, you're actually acting through a filter. You're acting through this film that's clouding your experience a little bit. And so with that being said, it's very important for us to recognize that as we come to the markets and trading, it's very possible that we either have experiences in the markets from our personal experience of trading, or we have things psychologically or limiting beliefs that inhibit us from trading our system, from using proper money management, from, we have a big loss, and we try and get those wins back. What is that trying to get wins back? That's just trying to feel better about the mistakes that you made to make up for it. And so, it causes us, those things, those limiting beliefs can cause us to go off course. They could be the very thing that's actually separating you from being a profitable trader day in, day out. I would be willing to bet 50 to 60 to 75% of you in here have a system, at least one, that could make money, that does make money if traded properly, with proper money management and proper discipline. But if you are not trading that system properly, if you're not using that tool correctly, then it will affect your trading performance. And so it's very important that we take time out, not just to learn how to read charts, not just to learn how to find price action setups, but how to recognize what limiting beliefs and programs are in our mind and then work to clear them. And so I actually wrote a really good article on this. It's called Building a Successful Mentality and Removing Limiting Beliefs. And inside that article, if you haven't read it, I actually give 5 different techniques for recognizing them and then replacing them and building healthy habits so that you have a successful trading mentality. So does that all make sense in terms of what I said about my experience with the motorcycle and how that imprinted on my psyche and then how it was actually influencing my moments from there on out? Can everybody tie that into trading and see how maybe you've had an experience in trading or something that is holding you back? I mean, have you ever experienced hesitation when pulling the trigger, so much so that you miss the trade? And then the next trade that comes around, maybe you pull the trigger on that one, but that one doesn't play out. And then you start shooting yourself in the head, and you start criticizing yourself. Well, if I had only taken that trade that I originally had, I would have made money and then I would have been done for the day. Instead, I missed that trade and now I end up with a loss. Has anybody ever had that? Anybody ever had that experience? I have. I had that in my earlier days for sure, and definitely during my learning moments. Absolutely. And it's very important to recognize that if these behaviors and patterns are there, what is it that actually caused us to do that? JP says, no, never. Maybe, it's possible, JP, that's never happened. I'm not sure if you're being sarcastic or not. Andrea says, yes, my experience this week in a nutshell, revenge trading. Yeah, and that's that's trading through a filter. That's not relating to the market from a transparent or one-to-one perspective. It's relating to it through a film. And when you do that, you're not relating to the market clearly with clear perception. You're relating it through conditioning and likely through limiting beliefs. So I definitely recommend reading that article. It's a very thick article in a sense that there's a lot of information in there, and it really points out to how important it is to recognize these, how important it is to build awareness around these things, and then how you can build some very simple, using some very simple techniques, a couple minutes a day to help build the right habits and the right mentality for successful trading. So Helder says, sorry, late here. I'll give you the link again. There it is. Okay, great. Well, with that being said, hopefully that will be useful for your trading and trading experience. With that being said, I do want to get into some trades. Ironically, even though I started the week late because of the accident, it's actually been a very active week for me, especially within the last 48 hours roughly. I've definitely had a fair amount of activity, and I want to talk about them. I definitely will be talking about them from a price action perspective. Keith says it's an okay article. Nice. Much appreciated. It's very kind of you. Okay. So you're all seeing a chart on the EURUSD. Let me expand this a little bit. I hope it doesn't mess up your screen. Okay, so you're all seeing this chart on the EURUSD. This is the 4-hour time frame. As all of you know, if you're beginning or still developing or learning how to trade price action, I definitely recommend starting off on the 1-hour, 4-hour, and daily time frames. You're going to find that you have much more time to spot the correct information, spot the setups, make your trading decisions in a very relaxed, non-emotional manner. And they're going to be generally be very clean signals when you do spot them. So I recommend starting off with that. But if you're more advanced than that and you want to go to smaller time frames, we're going to cover some of those setups as well. But I want to talk about EURUSD, how I made a trade on the 4-hour time frame, how I actually entered, stopped, limit, entry, exit, the whole thing, what I've used in my target. I think I'm still alive in this trade. I'll have to check. I'm not sure. It came pretty close to my target. But I want to talk about it, what I was reading from a price action perspective, why I entered the trade, how I entered the trade, and let's go through the details. So EURUSD has been on a pretty strong run since the sub 127 prints. If you notice, it's maintained its consistency above the dynamic resistance here of the 20 EMA. Many of you have known for years now, for almost 3-4 years now, I've been talking about how I like to use the 20 EMA and how it acts as an evolving or dynamic resistance. And you can see at several points in this trend, it actually held that. We only had one break, but it actually created a with trend setup. Now, many of you were paying attention. Ben Bernanke had an FOMC meeting this week, and he basically said, hey, I'm hitting the Control P button. We're going to keep rates virtually at 0 to 2014, which means real rates are negative, which means money leaves the US dollar, goes into high yield currencies, goes into gold, goes into silver, and look what happened. All the pairs just started beating up the dollar. The EURUSD climbed from, a low of 29.72 to 31.19, about 140 pips in less than 4 hours. So it climbs up on the news. Everything just takes off right at that point. Now, sometimes you're not able to catch these moves. Sometimes they're just too fast. And I'll admit, I did not catch the breakout, and I did not catch this move here. But I will tell you what I did catch is I did catch a nice reversal on it shortly after. You see this little thing right here? This little almost perfectly straight line? Not only is it a flag, but, you know, forget the fact that it is a flag. Technically, it's not a flag because this one violated way outside the flag here. But you see this right here? After a very strong, highly impulsive bullish move, if I'm seeing a strong close and there's very little profit taking, then what I'm looking for oftentimes is that kind of straight line. It doesn't always come, but when it comes, I'm paying attention to it. You can see two 4-hour candles open and close, you know, right on this razor thin line, and everything else pays attention to this razor thin line. Look at the penetration below it. We're talking almost next to nothing here. The penetration below this line was a whopping 6 pips and that was it. From a price action perspective, especially on the 4-hour time frames, but even on a lower time frame as well, when you see a razor sharp line that is being obeyed with such precision, what is that telling you from an order flow perspective? So that is a question to you guys. From an order flow perspective, what is that communicating to you? Someone has a large and open wallet. Okay? You're actually on the right track. 4-hour candles are very different. H4 candles on point. Who is your broker? I'm using the FXCM feed here based on the New York close. Chima says continuation. Jose says buy orders. Shooting Star says indecision. No bear willing to risk. Okay. The people that actually, Andrea says institutional trading. The price action you see is always a reflection of the institutional market because they are the most dominant players. So that's a standard no matter what. But the people that got it close, the closest were Dry Desert, no bear willing to risk. Actually, that's part of it. I'll give you half credit, Dry Desert. Person who got 3/4 credit was someone has a large enough wallet. That's you guys. Let's translate this from an order flow perspective. This razor sharp line is being obeyed with unbelievable precision. The only way that's happening is that if there are, first of all, there's very few bears in the market, and even the ones that are in there, all their orders are getting absorbed at a very clear line in the sand. If there was just profit taking, you would see a little bit more flexibility in this price action. But this line is so precise and so sharp and so sharply drawn that it's telling you that there are heavy institutional players that are absorbing those offers at a very clear line in the sand. If it was kind of they were playing with different levels or one player absorbed it first and then others started to catch on and buy it up higher, you would see a dip and then it would drift up further and further. We're not really seeing that. We're seeing an inflexible line in the sand. When I see that, that communicates to me that A, any offers that are in the market are completely being absorbed very, very quickly by generally very large pockets. And B, this generally creates what is called a gravity point. Some people call it a magnetic point. I call it a gravity point. So what that generally is that it becomes a gravity point, A, where buy orders are going to see this, institutions are going to see this. They're going to make some day trades here, trying to scalp a little bit here. But then some of the institutional players that are going to look for a bigger move, they're going to put a play or an order on this level, and they're going to go for a higher. They're going to expect this market to continue since all the offers are being absorbed, so they're going to look for higher ground. They're going to place their orders here. Because they've done that, that's going to not only, A, tend to create a very strong push to the upside, but B, when the market does pull back, that tends to create a gravity or magnetic point that the market is going to pull back to. So I said, okay, I definitely was interested in taking, seeing if I can get long in this, but I just didn't see the entries that I wanted to. Then all of a sudden this candle appears. This candle appears and I say, that's very interesting. The market did have a breakout of the high. It made it a little bit higher, but it rejected about 40% of the order flow, the bulls that enter the market here. So it rejected a pretty strong amount after A, breaking out of this short-term range, and after B, holding a line in the sand. So I said, watch out for this here. There might be a stronger rejection coming up. Then B, take a look at this candle. Look what happens. It opens, dips a little bit, a bigger dip to the downside than this one. This one just had buying straight from the open. This one had a little bit of selling, but then it climbed a little bit, barely breaks the new highs, and then what does it do? It comes back down into the range. That likely trapped some short-term institutional players in there who bought on the break of the high here. They got trapped, so now they're stuck. Their only option at this point is either hope that it continues higher prices, or they have to start exiting short because they are now trapped long. So as soon as I saw this candle, I said to myself, wait a minute, that creates an opportunity here. And what is that opportunity? Well, here's where the market's closing. If I were to take a position here and put my stop just above, I have, a 33 pip stop? And if I target this little gravity point here, I have what, a 56 pip target. So almost a 2-to-1 there, virtually almost a 2-to-1. Look what happened right after that. Aggressive selling. What happened is maybe it started off timid in the beginning, but to me, I don't think so. I think this rejection was saying, hey, guess what? We've now trapped everybody in. Sellers are now taking control. And look what happened. The market opens. It only goes a few pips higher. And then what does it do? Sells off right off the bat. Where to? Right to the gravity point. So this was a clear setup. It was an easy setup to trade. In fact, the market was so gracious. Guess what it did a second time? Right back to the same level. And then what did it do? Right back to the gravity point. So I actually had a 2-for-2 on this one here. I made the first one and it worked out really well. This was pretty timid price action. I said, you know what? I'm going to place another order here. Put the limit order in. That was it. It only went, what, to 60? And then what did it do right after that? Right back to the gravity point. I actually had several traders on the price action course that actually made the same trade. They all made some pretty good money on this one here. We were all talking about this one last night on the setup on this one here. So does everybody see how I made that trade, why I made that trade, what the price action I was seeing, the price action perspective, how I was reading the order flow? Does everybody see that? Okay, great. Fantastic. Okay, let's see a couple questions here, or at least one question. Todd says, how do you recognize when institutional traders are making this move? Which move are you talking about specifically? I want to know when institutional traders are making this move. Which move are you talking about? Just want to know which one you're talking about. So, okay, well, while you're rewriting that, Manoj has a good question. Why does price get drawn back to this gravity point? It's a very good question. Well, if you think about it, prior order flow creates a history. It's a history, but the important thing that's being communicated is where very clear lines of the sand are being drawn to the point where they create very strong moves. That's telling you very clearly exactly where the institutional players got in the market. They spent a lot of money to hold all the orders here, hold all the offers, and to create a very strong move since then. This is a 90-pip move after that there. So in terms of why does price get drawn back to this, well, it's very simple. If the market is going to reverse, it's going to revert back generally towards the mean, towards what is called a value area. That value area tends to be where there is a lot of dominant price action for a very long period of time. If it's dominant, then that's telling you that it's either there's a balance between the bulls and the bears, or in this case, there was any sort of sellers coming in, all of their orders were getting absorbed right here. That's where the institutional buyers were making their stand. So if the market is going to snap back in reverse, there's a very high probability it's going to go back to the location where those buyers were the first time, because that's where they were actually able to create the move. They pushed it up, so the market will pull back to that level. Does that make sense? Markets will tend to pull back to these gravity or magnet points because that's where the heavy institutional supply and demand or order flow was. I tend not to use supply and demand. I tend to prefer order flow. And so what it often will do is test those bulls again and say, hey, okay, we've pushed back. Are you guys for real? And there will be some players that will have orders here parked a second time thinking, hey, guess what? To try this again. Some of them might have survived this little dip. You're only talking a 20-pip dip roughly here from that. Some of them might have survived. And what did they do? Some of them might have made it back out again to this little point here again. So to me, that kind of explains the nutshell. Does that answer your question, Manoj? Why the market tends to go back? Because that's exactly where the institutional market had created a very, very strong, that's where they said, we want to enter in the market. And so if that is a key level to them, they're communicating that with a lot of money. And if they're communicating that with a lot of money, that's telling you where they tend to see this is a place we want to buy it. This is where we think is a key level. So hopefully I answered your question. Okay, great. So let's see. Todd says the question you asked that Andrea answered correctly. Okay, that answers your question as well. Okay, great. All right, great. Fantastic. T-Bag says, why don't you just call it support instead of a gravity point to avoid confusion? Because that's a great question. Gravity points, I don't call all support and resistance levels gravity points. There are many different support and resistance levels. I call it a gravity point because it has a unique characteristic to it. It's kind of like not all support and resistance levels are created equal. Some are more important than others. And so I could call it a support point or a resistance level, but the problem is that that may not have as much potency as, or it might not communicate as much if I call it something that has a unique qualification. Not all support or resistance levels are going to look exactly like this. And because of that, they're not going to necessarily create the same reaction from the market. So depending on how the market responded to that from a price action order flow perspective will determine how the market responds to that support or resistance level. So that's why I call it something a little bit different, because it has an extra qualifier to it. It's a little bit more unique. In fact, it's probably not something that if you were to take the next 10 support and resistance points, they're not going to necessarily look that clean. So I call it that because of the additional qualification and characteristics it has. Hopefully answers your question. Jose says, would you consider buying a pullback to the original breakout of the big spike? You mean this one right here? That's definitely, you know what, I'm going to answer that question when I get into the 3-minute plays on the Aussie and the Kiwi, when I look at the 3-minute time frame. So I'll answer that question then. So if you don't mind waiting, that would be great. Helder, I will answer your question at the very end of this course. I'll give you a link to that there. Dry Desert says, or Rivik says, do institutions follow a certain technical method which is unique, and what is the common practice? Institutions don't have like, okay, this is the one method that they're playing and that's it. Every institution has different objectives and different ways they approach the market. They're going to have a team of day traders, but they're going to have a team of people who make long-term plays. But I will tell you this, institutions, every single one of them I've ever met, and I definitely know a lot of them. I know a lot of former bank traders. Last time I was meeting with 2 former bank traders, 2 actually dealers. They all know price action. They all know price action inside and out. And they all learn how to read that. So if I were to say the one common thread, it would be price action. Dry Desert says, could you say something again how sellers are trapped at the close of the Morningstar candle if that is Morningstar? Great question. So what happens is that the market's clearly in a very strong move at this point here. The sellers, all their offers are being absorbed. The market's looking to make higher prices. It basically just said, hey, no sellers are willing to counteract this here. So we have our little gravity point here. What happens is that there are going to be intraday traders that are going to take a break above this particular candle here. And so what happens is when it breaks this, there's some traders that are going to take that play. Now, this candle right here closes above this little flag or range or whatever you want to call it. They close above that. Closes right here. Well, there are people, since it's still, even though it's a rejection, it's still a pretty strong enough bullish close that the market is still, particularly the day traders, are still thinking more bullish than bearish. And so what's going to happen is that on the break of this high, you know, look at this open. The market doesn't dip that much, and then it climbs pretty quickly, communicating buyers are still dominant in the market. So guess what? On the break of this, they're going to see new intraday traders take fresh longs here, maybe trying to gun for 32, a little bit higher. And what happens is that this thing only went to 83, 9 pips above, and then it reversed back into this range here below their entry. So that means they're trapped long. And they're either going to get their shorts triggered, their stops triggered, which is a short, or they might hold it thinking that the market's going to come back, and then as it dips further and further, they realize they have to get out, they're going to have to take the loss, and then that actually helps to steam or fuel the reversal. So hopefully that answers your question, what I meant by that. Okay, Jay Thomas says, just a what-if question, but at 14:32 news, U.S. GDP Draghi speech pushed down the price to 30.95. What if a different data, different response would have come? You know what? It's hard for me to answer that because until I see the price action, it's just, I have no idea what it's going to look like. And my job as a trader is to relate to what I see in the charts. I'm trading what I see. And then I'm taking that information, I'm assimilating it, and I'm trying to translate into, okay, what kind of order flow created that kind of market? Who's in control, the buyers or the sellers? What are the key points that they've entered? What are the key resistance levels they've run into? And then at that point, after seeing what that looks like and what the market has manifested in terms of real price action, then I can make a decision. But until I see that price action, that scenario that you're talking about could create all kinds of scenarios. I can think of 1,000 different ways that could look like in terms of the price action, and so that would obviously depend, based on the context, how I trade it. So I need a real setup to say, hey, this is what I would do. It all depends on how aggressive or how timid that pullback was. Manoj says, have you noticed prices bounce off the gravity point now? Absolutely. That's because institutional players still consider this an important line in the sand. Boom, right back to it. So they're still playing this. Keith Shaw, last question, then I'm going to move on. Chris says, the initial stimulus for that spike up was a news-driven, right? Once that news had been absorbed, the following price action gave you a nice technical setup regarding the gravity point. Correct. Correct. You know, and I'm generally not too interested in news-driven events as a whole, but this one was kind of unique. This one was unique. It created a very strong response out of the market. You know, this 4-hour candle was an incredibly large 4-hour candle from open to close. And so with that being said, you know, when I see a very unique response, that's when I'm interested. Generally, news events don't create that strong a response. And so to me, I'm not really that concerned about it. But when it's unique and the price action stands out, that's when the hairs on the back of my neck come up. That's when my ears and antennas come out and say, hey, pay attention, there's a trading opportunity here, bull or bearish. Okay, great. So real quickly, I just want to show you another example of this on another pair that exhibited the exact same behavior. And then I want to get into some intraday plays as well. In fact, it's almost textbook the same. There we go. Okay, so let's bring the chart back on. There we go. Okay, so this is the same candle for the same event. It didn't create it as long. The other one was 4 candles, which is 16 hours of price action. That means at least 2 different sessions had actually participated in that and said 2 different sets of players. It could have been European and London, London and Asia, London and Asia, London and New York and Asia. 2 different sets of institutional players for 16 hours said, this is a line in the sand. That's a very strong communication. This one was only 8 hours. It wasn't quite as long, but it was still almost the same thing. It was a very kind of, I mean, look at this, what happened right here. And we're going to actually look at this from a 3-minute time frame, which is why I'm not spending too much time, but I want to show you the same thing. This thing opened, the low was the open. So that means that the buyers had entered the market from the open. At the point they were so dominant and strong, or the bears were so absent, nobody could actually push it down 1 pip. That tells you how strong the bullish market is. So it's a very sharp line in the sand there. It closes on the high, and then as soon as it breaks out, boom. We actually had traders that actually took the close of this candle, and they made quite a fair amount of pips on this one here. This is a particular signal that we have. But I want to show you the exact same thing. Look what happens when the market rejects. Right back to the gravity point. And then, watch this. Right back to, remember I told you that little open and close thing right there, where the rejection, here's the open and close from this rejection. Another rejection didn't make it quite as high, very similar to the euro-dollar one. But look what happened. Went right back to that open to close, sold off, right back to the gravity point, and then the market has been buying it up again. So this is a very clear line in the sand when the institutional traders have said, look, we'll make it easy for you. If you missed it this time, and you missed it this time, you should have been able to make it this time. It's only like a 2-pip difference. So this communicates exactly how important these gravity points are. So hopefully answers your question. Okay, so now I want to switch off this chart, and I want to bring up 2 charts. In fact, let's get into Aussie real quickly since we're already on Aussie on a 3-minute time frame. We're going to actually take that look at that spike from a 3-minute time frame, and then what we're going to do is I'm going to show you 2 little intraday plays I made, and then why I actually passed on a particular trade. And then I want to show you exactly how I made a couple plays on Kiwi and gold. In fact, some of these I even wrote about ahead of time. No, you don't need to refresh. I'm just putting up a new chart. Okay, great. So here is, let me zoom out just one more. Here is that same event. We're just looking at a 3-minute time frame. The market, after a very strong series of buying, finally runs into a combination of sellers saying, okay, this is too far, and some people taking some profit taking. But it must not have been too strong a sellers, and it must not have been too much of profit taking, because even though it's a strong rejection in this candle, is a stronger rejection or a stronger continuation of that. The bottom line is the market starts to absorb it and starts to push it back up. Now here's the structure I want to get into and show you a little intraday play that I took. Do you see how the market, after creating a temporary floor, bouncing back up, created a lower low? Well, after that, the market drifted back into here, and then it kept testing this little level here. I want to show you something here. It kept testing this little 2-pip level here after that. So this was kind of a false break, and then look what happens. The market keeps testing this level here. So institutional players on an intraday basis are buying this up. They're buying this up. They're saying, hey, okay, the market seems to have settled. This is a false break, and we're settling around this little level right here. So I said to myself, that's interesting. All right, if this level is going to hold, and this really was a false break of that, then there might be a play back down here, possibly looking for a move back up to here. Well, I want to show you a trade I did take, and I want to show you a trade I passed on, the exact same setup. So now here's a spike high, pretty close to the prior high there. It's more of like a general ceiling within this shorter range here. We get a nice little pin bar rejection right off of here, and the market comes right back to this exact same support zone here. So it's a no-brainer trade, especially for a short little intraday play, and if you like these intraday plays, it's a no-brainer trade. You could have literally survived with like a 7-pip stop, targets 14 pips, 2-to-1. It's a quick one, it's a fun one, it's easy, it's a no-brainer. Especially if you're just an intraday trader, this is the kind of thing you want to look for. The market settles in a flag, has a false break of that flag, and then continues to settle back into it. You take these plays back up here, you should be able to get a good 15, 20, very quick, very easy. Now, so I took this play, market hold, goes right back to that level. Very simple, very clean, done deal. Now, I want to show you why I didn't take the second play. take a look at, and I want to slowly, okay. I want to tell you why I didn't take this one. Can anybody take any guesses looking at this second rejection here? Actually, it was 1, 2, 3, 4. Does anybody have any guesses why I did not take this pullback this time? Any ideas? Any guesses? Well, okay, let me put it this way. Here is where I was when this trade was coming down. So Harley says broke through resistance. Breaking through resistance didn't mean that much to me. That's actually a sign that the bulls are more in control. In fact, this was the strongest push-up of all of them, saying that the bulls are very in control. Momentum was down. I'm not looking at momentum. I'm just looking at pure price action. Rather support. Move was too strong. Much stronger bears. Less candles stronger. Okay. DAVA, TMA, Corm, and Solitaire and Fernando, we all got it. This move was the strongest from a price action response of all of them. We did break resistance, but then we kept getting stuck here. From the strongest bull intraday move inside this entire level, or this entire series, we got several rejections here, and then look what happens. The market rejects this strong intraday move and then sells off more aggressively than any of the prior rejections. So that's telling me that, you know what, they have taken control from the intraday bulls here, and they've pushed back with their strongest pushback yet. That tends to be the moment where a support level gets broken. Support levels or resistance levels are very rarely broken on small pushbacks. They tend to be especially if a range is held in such a consistent fashion. They usually tend to break with force. It's that extra force or that impulsive price action that is communicating to us, this is a stronger pushback than we've seen before. Now is not the time to be taking this play off the support. So I said, you know what, this is much stronger. I'm walking away from it, and look what happened. Broke right through it. Maybe it was intuition, maybe it was my experience, but the bottom line is the combination of this rejection from a strong up move, the strongest up move in this series, combined with the strongest rejection, all communicate to me on the moment, don't take this bounce. So hopefully that answers your question, or hopefully that explains why I took that. Now, real briefly, I just want to get into a couple quick questions, and then I want to show you a 3-minute on the Kiwi. Actually, I want to show you a 3-minute on gold, and I want to show you a 3-minute on Kiwi. I even wrote about this gold one ahead of time, giving you a cue as to how you can trade it. And before, I just want to answer these brief questions real quick, and then we'll move on to gold. Jano said, what's your spread on Aussie and silver? It's a little unfair to me to be saying this. I have about anywhere between a 0.9 and a 1.2. But you got to also understand I'm trading, on a much larger size account. And that's just my personal account. The spread that we have for the fund is about 0.9 on the highest. So we're trading enough capital that they give us really good spreads at this point. Anybody can get these spreads. You just have to have enough capital. Silver, I have about 0.2. So, silver, I don't know what the retail, I think retail is like a 0.05. I have about a 0.02 on silver. Element alone says, Chris, seems like definitely Forex market is designed to make retail traders to lose sooner or later. No option for us in the long term. Momentaneous gains. That's a very pessimistic look at it, Element alone. The Forex market is not rigged so that you guys are supposed to lose money. The bottom line is you can make money trading Forex. Anybody can do that. It's not some rigged game that's deliberately designed to completely screw all you guys. That's just not it. The bottom line is the institutions have this. The institutions are more concerned about the other institutions than they are you guys. They're mostly playing a game amongst themselves, and they're trying to outsmart each other. Think about it. If you are if you command an army of, say, 10,000 strong, are you worried about the little tribe leader that has 15 people in his army? Probably not. You're more worried about the other armies that are 10,000 strong, or maybe a little bit bigger, or maybe just a little bit less. So they're really competing against each other. And it's in that dogfight that you are participating. But if you're smart, you can learn to, through price action, to spot what the institutions are doing and how to take advantage of that. So I don't think it's designed to make you lose. I don't think they really give a crap about you guys. And sorry for my language there, but I don't think they care about retail traders. There's not enough money in it for them. The big money is being able to do what they want to do and outsmarting the other big players on the market. So they're playing a different game. I completely disagree that there's no option for retail traders in the long term. I have tons of traders in my courses that make money day in, day out. I just had one trader. She's American, lives in China. She's doing exceptionally well, and she trades just a few handful of our systems, and she does exceptionally well. And so it's something that can be learned by anybody. I think that's a pessimistic attitude, and more traders are becoming more profitable as the market goes on. A few years ago, 6 years ago, maybe 10% of the traders were profitable. Now it's about 25% globally. So hopefully I answered your question. Okay, last thing our goal says, it takes a great deal of effort to trade price action, I think. It's a learning curve like anything. But, you know, the bottom line is that if you do it right, if you have the right discipline, the right money management, you learn how to read it, you'll see your skill set build, and that will be a self-reinforcing feedback loop that will communicate to you, wow, my skill set's increasing. I'm able to spot these opportunities. You know, especially if you have rule-based systems, that will accelerate your learning curve. So it takes time, it takes some screen time, it takes practice, but that's like anything. It's like anything. If you want to be really good at something, it's going to take time to learn it. And so if you're disciplined, if you're driven and you're motivated, then it can be learned by anybody. Don't ever think that it's something that can't be learned. It totally can. All right, fantastic. So for those of you that have any questions about our services or anything that we do, check us out, secondskiesforex.com. And I always like to hear from you about our, any questions about us. Feel free to email me directly at secondskies.com. I'll be back next Tuesday. So until then, have a great weekend. I hope you guys have a good week. I hope you enjoyed this webinar. This webinar is recorded, so once it's up, make sure to view it over the weekend, review it again and again and again. All this stuff is totally learnable. So have a great weekend. I'll see you next Tuesday. Take care, everyone.